With an economic recovery underway, some analysts have started to feel optimistic about investment prospects, but one must not forget that a resurgence of COVID cases still lingers on the minds of many investors. Joining me to talk about the markets today is Rick Rule of Sprott U.S. Rick, welcome back to the program.
A pleasure, David. Thank you for having me back.
It's been 2 months, almost 2 months since we last spoke. What is your assessment on how things have progressed, Rick?
Well, with regards to the interview, if you do enough of them, you get a couple of them right. We said in that interview, I think, that precious metals prices would be higher. We were right. We said that precious metals equity prices would be sharply higher, and we were right, too. So in terms of our track record, yours and mine, after 2 months at least, we're unblemished by failure. Let's hope we do as well with this interview. Looking, of course, at the broader economy, I think that's less rosy than our own track record. My suspicion is, as it was then, that there is a major disconnect, at least in American terms, between Wall Street and Main Street. And I suspect in Canadian terms that there's a disconnect between Bay Street and Main Street too, which is to say that people are hurting. The broad economy is weak, but debt and equity markets are strong. Why is that? Are they anticipating a recovery, or are they strong because of artificially low interest rates and quantitative easing? My vote is on the latter. My vote is that the equities rally that we're seeing in particular, but the debt rally that we're seeing too, is a function, A, of artificially low interest rates, which chase savers into riskier asset classes and lower the cost of capital for borrowers. It's also due, of course, to quantitative easing. Excess liquidity in the market, liquidity forced in the market, not contributed voluntarily by savers, And finally, in the United States, by the oddest circumstance of all, which is the Fed, that is to say, Americans, or unborn Americans more specifically, buying assets directly, buying junk debt, buying equities, buying bonds, buying municipal bonds. The idea that the market is rising if you discount or take away the impact of the Fed buying asset classes directly, which is unprecedented in American history, I think puts the rally that we're seeing in its proper framework. Doesn't mean it can't continue. It doesn't mean it can't continue. But I think that anybody who looks at the current circumstance and draws courage from equity prices and debt prices needs to look at the construct of the bull market and the foundations of that bull market and draw their own conclusions as to how confident they should feel.
Well, clearly market bulls who, are the ones really driving the equities rally would argue that fundamentals are less relevant than quantitative easing. I think I've asked you this last time as well, which is why you think fundamentals matter at a time when Fed liquidity injections are really what's driving the market, regardless of where fundamentals are at.
Maybe the reliance that old men like me have on reality is counterproductive. I still believe that a share refers to partial ownership in a business. There are people, perhaps on Robinhood, who believe that a share is an ephemeral mark to market, which is to say, a way to speculate on a trend in motion. They and I will have a dispute which will last until one or the other of us is proved to be right or wrong. My suspicion is that I'll be right. From my point of view, bull markets that aren't based on growth and aren't based on value end in tears. I'm not suggesting, by the way, that 10 years from now, equity prices won't be higher, even substantially higher. What I'm concerned about is the next 3 years. When I look out over the next 3 years, I have a difficult time seeing the circumstances that would promote real economic growth, exceeding those circumstances that would constrain economic growth. And the consequence of that is that I see a very difficult time maintaining values that would underpin an equity rally separate and apart from quantitative easing. As long as confidence exists, particularly in the United States, the big brother in the North American economy, as long as confidence exists, then quantitative easing works. The difficulty is that my suspicion is that anything that shakes confidence at all will cause people to use their skills at arithmetic, that is, their ability to subtract rather than just add, and that confidence might begin to fade.
Right. So talking about confidence, since last we spoke, in the last 6 weeks to 8 weeks or so, we've seen a roller coaster ride of data come out, surprises both to the upside and downside, particularly in regards to employment. Unemployment has fallen really faster than market analysts have expected. I'm not saying above 10% is still, a good number, but a lot of people were expecting it to be worse. Do you see this as a time to maintain confidence given that recovery is underway, albeit rather slowly?
In a broad economic sense, the answer is no. Of course, company by company, certain companies can defy statistics. There are some businesses out there which are just extraordinarily good businesses that will do well in any circumstance. But if one is talking about the broad economy, and one is talking about, as an example, index earnings growth, which is to say earnings growth in the S&P 500, as an example, it's very, very difficult for me to be bullish. It's particularly particularly difficult to be bullish when I think about the construct of the liquidity and the growth, the artificially low cost of capital afforded by artificially low interest rates, the intervention of the United States in equity and debt markets. Difficult, too, when you think about major industries in the United States and in Canada. Hospitality, as an example, restaurants, hotels, airlines. The air pocket that we have hit is a very real air pocket. And to see the market ignore those air pockets, ignore the hits that the economy has taken and likely will continue to take, makes me very nervous. I'm not sitting here saying sell all your stocks. I am saying buy shares in businesses that you believe are undervalued and businesses that can weather the storm. Don't buy the market. Buy great people, buy great companies, and maintain a lot of liquidity. If nothing else, David, 45 years in these markets, tell me that the collision of liquidity with a poor economy will generate nothing without volatility. This is a market, I think, where you will see extended periods of time with the VIX, the volatility index, above 20, meaning that 10% monthly rises and 10% monthly declines will become commonplace. And that will unnerve investors. Those investors that have plenty of personal liquidity will be able to use volatility as a tool rather than being used by volatility.
I think your thesis on buying great companies is it resonates with a lot of value investors. Warren Buffett would be probably somebody who shares your thoughts. Where your views and his might differ is in regards to gold. He has famously dismissed the yellow metal, whereas you are a champion amongst gold bulls, Rick. So, tell us about where the disparity lies.
Your wonderful colleague, Daniela, and I had this discussion about 2 years ago, and it's a very amusing discussion, I think. For each of us, we are both right. Buffett doesn't need gold because he is a superbly intelligent human being who manages vast amounts of money in businesses that have pricing power. When inflation strikes, when the currency is debased, Buffett is invested in businesses that are leaders in their segment and can increase their profits, and they have such huge capital bases that there are barriers to entry for new competitors. So for Buffett, he doesn't need gold. But mortals, people like Rick Rule and David Lynn, absolutely need gold. We have neither his experience, nor his discipline, nor his capital base, nor his portfolio of world-leading businesses that can raise prices. And by the way, world-leading businesses bought at a third of today's values. So I would suggest that for Buffett himself, he is right. But for mortals, for people who, for whom government policy matters, for people whose savings may or may not be sufficient to get them through the rest of their lives, those people need gold. Buffett's position is so strong that he is almost impervious to the idiocy of Congress and Parliament. But you and I aren't. And over time, gold has been a wonderful way to insure one's self against the depreciation of the spending power of our savings over time.
Okay, I want to go back to the economy for just a minute here now. President of the St. Louis Fed, James Bullard, has issued a statement recently, and I quote, "We could get a wave of substantial bankruptcies, and that could feed into a financial crisis." He's referring to, of course, the resurgence of COVID cases, second wave, as you might call it. What does he mean by feed into a financial crisis? Is he implying that we're not in one already?
I think he is suggesting that we aren't in one already. I think he is suggesting that the big thinkers of the world, including the Fed governors like himself, have, in Canadian parlance, stick-handled this crisis. Rising equity prices, stable debt markets suggest that from their point of view, they have done their job, that confidence is maintained. To the extent that you begin to have more debt defaults, and there are numerous places that this could occur, hotel bonds, hotel mortgages, airline bonds, oil and gas company bonds. To the extent that we begin to see credit defaults, and particularly to the extent that we see defaults in the high yield or junk debt markets, it would be very easy to shake confidence. You and I have discussed before the fact that the junk debt markets are particularly vulnerable. And I don't want to sound like a perma-bear on this interview, which I'm in some fear of sounding like. But I think he needs to be particularly concerned about the junk debt markets, because so much of this high yield debt is owned by income-oriented investors through highly liquid, high yield ETFs. And if the individual investor's faith in the credit quality of the debt held by those ETFs gets shaken to the extent that they sell the ETF managers must sell the underlying debt. The problem is that the ETFs themselves are hugely liquid. They trade like water, but the underlying bonds are often very illiquid. And if you have a circumstance of disintermediation, which is to say a crisis of confidence that causes people to begin to liquidate the ETF, and the managers have to sell the underlying assets, they will learn about something that I used to call an owl bond. An owl bond is when you call your broker and ask him or her to sell, and they say, "To who? To who?" And I think it's the to who that has the gentleman rightly concerned.